How much home can you afford? I'm here with Sherby Ortiz. My name is Raul Jimenez, and we're here to talk about what we have to do to get prepared to buy or to sell. So Sherby, talk to me about what some of the major concerns are when people say, I want to buy a house, but I don't know how much I can afford. How do you play it all together for them?
Great question, Raul. I think my main goal and objective whenever I look at someone to get pre-qualified is take a look at everything that they have in their finances, from what shows up on a credit report, maybe even daycare, maybe even other expenses that they may consider or not consider. But the whole objective is budget.
Okay.
I know that's a big word, and I know that sometimes,
Lower B or big B?
Yeah, right. In this case, I would put a big B, right? Super important, because if the objective is to actually live in a home that, creates the comfort and the lifestyle that you want for you and your family, is how do we fit into that, right? And so at that could be take your household income.
Okay.
And whether it be side gigs, hustles, in this case, where everybody's selling online, there's Uber Drive, there's whatever. I'm hearing it all and I'm seeing it all because the internet is available, right?
Sure.
And so take all that in consideration and then multiply it times whether it be 40%, 45%, whatever that number is. So if it's $100,000, 45% is $4,500. That's your total cap of expenditures. After that, subtract whatever you're actually spending already right now.
Okay.
Car notes, maybe student loans, credit card debt, any other kind of loans. And then the leftovers, what you're going to have for a mortgage payment for your house.
Okay, so right now you're basically hitting the next point on what is DTI, debt to income ratio. So tie those two together.
It is super huge. All the loan programs have some qualifications and some requirements as to be able to get you the loan. One of them is the debt to income ratio, right? So the bank wants to make sure that you're budgeting, that your expenses are low, below 50%. That way they know that we're not going to go into a payment shock or payment default or of the like. And so the debt to income ratio is one of the key factors as to determining how much of a home you can buy, right? Based on the total income and what you have budgeted left. This might be a time to maybe, consolidate debt to be able to get a house. This might be the time to refinance a car. This might be the time to trade in that car and get, a different car, right? Mm-hmm. So I think it's how do we actually make it work to be able to aim at buying a home that you're looking for, whether it be your first home or second home.
So great tie into the next question. What is debt to income ratio? How's that factored? And how I always explain it to my clients is whatever you spend monthly and then it's reduced by how much you actually make yearly. But what is the layman's terms of what you look for when we see debt to income ratios?
The simple way is just take total household income, all the gigs that someone may be doing, right? Maybe side hustles, selling something on the internet, Uber, whatever that is. Take your total household income and multiply it times a comfortable number that you can live with. You could do 40%, you could do 45%. Mm-hmm. If it's a single person going on a home loan application, sometimes they go up to 50% because they know there's another income we just can't put on the application for whatever reason or count as qualifying income. But that's the magic number. So let's just say if it's $100,000 a year household income, 45% out of that is $4,500. From that $4,500, subtract what your liabilities are paying per month. It could be a car note or two. It could be credit cards. It could be student loans, any other kind of loans. The leftover is the ideal mortgage payment that you'll be able to afford it. You can have to be able to buy a house.
Now, and you're plugging in taxes, insurance, the whole 9 yards, correct?
That must be a must, right? So most loans nowadays come with a minimum down payment, BFHA at 3.5% down. Conventional could be as low as 3% if it's the first time buying a home, or minimum 5% if it's your second home or third home. But that's the math. You want to calculate the principal and interest. You want to calculate what the homeowner's insurance is, the property taxes, and even mortgage insurance.
Sure.
Put it all in the mix. So a good mortgage calculator, if you go to SanAntonioHomelender.com, that's my website. There's a mortgage calculator on there that gives you all the tools to be able to do that.
Well, we always talk about, trying to get, financially debt free or whatnot, and everyone talks about, living below your means. What would you say as far as with the mortgage, what would be below your means? What is that happy ratio, or what is that kind of sweet spot, would you say?
I would say that living below the means probably keep it about 45% or 40% debt to income ratio,
Okay.
right? So maybe this is not the ranch house you wanted to get. Maybe this is not the condo in downtown or the house in the outskirts and so forth. But this could be the vehicle or the house that's going to help you get there, right? And so can we be comfortable with a house that is the right square footage for the family? It's not too big, it's not too small to then grow from that into the next investment. I think that's what is necessary, right? Does that mean that we do need to buy the car that no one else is going to see because you work from home and it's parked in a garage, right?
Yeah.
And so probably not, right? So it's just making more financial decisions that is central focus, is super focused to the home that you want to buy. Maybe not just now, but maybe 5 years down the line.
So what you're saying is I should hold off on the yacht.
Don't do it. Don't do it. Not right now.
So you had mentioned it a little bit earlier when we were talking about the different loan programs. Obviously, the main ones, especially here in San Antonio area, are the FHA, VA, and conventional. You hit a couple on FHA being 3.5% down, conventional being 3 to 5%, right, depending on what it is. What about VA? We have a lot of VA buyers here in San Antonio, Military City, USA. Yeah. A lot of people know that they could get in as little as 0%. What is your take on that, and what are the pros and cons of what we look at?
Good point. So the best advice I can give for veterans, and yes, there is 100% financing. What that means is that whatever the purchase price is going to be, that's the 100% financing you're going to get from the lender. And that is good. However, still keep your budget in place, sure, right? And so as a lender, we have to consider what is called a residual income. Well, what does residual income means is that after everything that shows up on the liabilities on a credit report, car loans, credit cards, and so forth, what else is being paid for per month? Right. Is it daycare? What does utilities look like? What is that average? And they got to have, every state is different. They got to have, a leftover monies that is going to help that veteran or active military to be able to sustain, in addition to the BAH and so forth. So still, I would say, keep the budget tight, even though you're getting 100% financing.
Good point. So we're talking about the down payment and what we have to prepare for, but there's a lot of other things that we see on the CD when we get actually to closing, some reserves, some extra taxes, insurance, things like that. Will you walk us through what that looks like and what we might be able to forecast as far as what we need to have in reserves?
Absolutely. Every loan is different. FHA may require at least one minimum month of reserve, or up to 3. Conventional may as well. What that is that as a lender, looking out for the best interest of the buyer, we don't want all the closing costs, or we don't want the down payment plus closing costs, which include third-party financing, sure, companies, to be all in at closing and then not have any leftovers for the first payment, right? And so we want to make sure that not only do we set it up right per month to be able to make affordable payments, but we set them up good for at least the first 3 and 6 to be able to have some cushion on there. Reserves, of course, is a total payment, including principal and interest, taxes, insurance, mortgage insurance. That total monthly payment, we got to have enough to carry through for the next 3, I would even say 6 months, okay, as far as when it comes to closing, and have a projected future of savings as well.
Got you. One of the things I like to educate and kind of talk things through. We always say I get the traditional 30-year mortgage, because then if your finances change or anything happens along the way, you have that set monthly payment that won't be super high. A lot of people like to say I'll get a 15-year, it'd be I pay it off quicker, or maybe even something a little bit different. But is it true? I mean, I think I know it's true. But one extra payment gets you down to 22, 23 years, and 2 extra payments will get you down to a 15-year note. So would it be safer just to go the 30 and then just be diligent enough to throw the extra payments on? That way, if your budget or anything changes along the way, that you're still comfortable enough to make that minimum payment, rather than have an extra $800 or $900 obligation every month.
Absolutely, 100% agree. Right. So keep your payment as low as possible. If you get a bonus, if you get extra commissions, if you decide to treat yourself during Christmas, pay yourself back and put that money into an extra payment on a mortgage, right? That would certainly shave off some equity, but at the same time, will shave off a few years, 4 to 6 years. And so can you do it at 15-year note, and then just go all in with the higher payment? Yeah, you could.
Right.
But just keep in mind that the lower the term, 15 years, from 30 to 15 years, the lower the term, the higher the monthly payment, which means that we have to still consider that debt to income ratio,
Right.
which could entail buying maybe less of a home
Sure.
than what you could have wanted to on a 30-year note.
Got you. Well, friends, there you have it. Chevy Ortiz, if you have any questions about what you can or cannot afford, please give us a call. Other than that, we hope that you have a blessed rest of your 2023. If you need anything, we're here to help. Thank you very much.